what I can say is we were careful to, one of our, I guess our most important metric was a public market equivalent. So what we did was essentially took our group of impact investments and then compared them to what we thought was through the cash flows in a public market equivalent, which we chose as the Russell 2000. The Russell 2000 was gross of fees as well. So yes, you could pay lower fees on getting someone to manage your money into the Russell 2000 or other microcap stocks than you would into a bunch of private equity funds. But we did, that is to some extent apples to apples as a comparison. I guess what I would say is hang on, stay on the line, because we actually are coming up with a follow-up report which will look at net of fees and actually compare net of fees in the private market, the traditional private equity market, to net of fees in the impact investment private market. And that's probably the most salient comparison, and it's actually with a much larger sample set as well. So that's probably, like, if I were going to speak to a fiduciary, I think that's the study I'd want them to read.
If I can add a little bit to that answer, not necessarily gross and net of fees issue, but I think to some extent market returns are somewhat in the eye of the beholder. And we created a sustainable real asset strategy with a mixture of private equity funds, and one of them has an expected return of 7%. For private equity, that's below market. It's certainly far below market. But in terms of the objectives of the foundation, a 7% return would be considered market if you look at it across, if you compare it to other asset classes. And so in some situations, foundations have put that in their traditional portfolio as a market-generating investment. But in some other situations, we've seen them move that into a PRI, because they see that as below market, below the private equity market expectation. Is that a fair?
Yeah, I think so. I'd add one other point, which is, when you look at a distribution of the kinds of returns that you see in private equity, in traditional private equity, you see that the median, the true median of private equity, not what they show you on Cambridge Associates, but the true median of the industry, if you look at like a paper like Steve Kaplan's paper, Kaplan and Shore, what you see is that it's actually not performing that well, right? So it's not risk adjusted. You have to be in the top quartile if you expect, you have to be in top quartile funds if you expect to get those private equity returns that we think of as risk adjusted. Well, it turns out the impact investing space is precisely the same. When we looked at the distributions, it was remarkably similar. So I guess the moral of the story is, like, you should have a portfolio, and they should all be top quartile funds in your portfolio. So.
I think one other thing that I think is really important, in particular when you're talking about impact investing, is paying attention to who your intermediaries are. There's a ton of confluence towards this idea. There's a ton of demand towards these kinds of solutions, and now there's a whole lot of people who are throwing out a shingle as an impact investor that is running a product. And at the end of the day, it really comes down to understanding those strategies, understanding the solution, understanding the intent, and really understanding what you're paying them. Because in a lot of cases, those intermediaries are the ones that, they're offering you something that is super impact aligned, and it's below market rate, but I'm making a mint. And so it's really just making sure that there is that solid alignment of interests between the people who are deploying the capital and the people who are fronting the capital.
To enhance that answer a little bit, I can't tell you how many times I have managers coming into my office and pitching their impact strategy. Let's say it's a clean energy fund. And my first question is, so show me your impact metrics. I want to see your success record from an impact, a non-financial standpoint, not a financial standpoint. And I have had those same managers look at me like I have three heads. And so to me, that's an immediate exit out of the office, because you're not an impact manager, you're greenwashing your strategy. And so just be careful when somebody's pitching the new impact strategy. Make sure you ask what I think is a fundamental question. Are you paying as much attention to your investment results as you are to your non-financial results?